Welcome everyone. We have another review here in Mere Finance. Don't forget to subscribe and let's begin. So there's some rate cuts that are coming, probably 25 bips, but it's extremely dependent on the movement of the dollar index. So let's see how the market is going to react, and especially how important is the dollar, not only for inflation, for rate cuts, but also for the election cycle. If you see here, this is a chart from Charlie Value, Fed funds rate versus core PCE inflation rate. Core PCE basically is everything but your food and energy. You can see how the Fed funds rates in the lower bound is 525, usually it's 533, the effective target, but the lower bound, 525. You can see the spread is definitely improving, so seems like the rates are doing its job. After, you see from 2020 to 2021, basically zero, and from 2009 to close to 2016, basically 0 too. So all of that policy made a lot of, inflated different assets, but the pandemic and low interest rates really hit inflation, although it's coming down year over year. So that's the good news. Seems like it's doing its job so far, but there's so much risk going on. So if you were aware, August 30th, we finally saw that the 10-year treasury and the 2-year treasury, basically, that differential part of the curve now is flat. This didn't happen since Tuesday, July 5th, 2022. And what does this imply? It implies that the market is seeing now everything is becoming normal, but every time there's an uninverted yield curve, there's an imminent recession coming. That's what it says. But just seeing that it took 2 years and almost 2 months for the curve to invert shows that we have been in a stressful period, the longest ever. And this inversion shows that growth might be compromised in the future. So let's check the yield curve. So there's a lot of information, but we're plotting every single month end from this year. You can see the highest ones is the kind of pink fluorescent line. That's April, and the blue one, it's May. So you see April had the highest yield curve across, then in May, and we're going to see how this correlates with our dollar index. And as you can see in the lower, that's the orange line. That is not August, that is July. So this is an interesting point. You can see there is a tendency across the year since May for rates to start going. So you can see June is the green one, we can see lower, and then completely down again in July, a big drop in the yield curve. However, money market capitals, which are at the left, upper left, are still pretty constant. But you can see the decrease since May of the yield curve. But what is interesting, even though it is hard to believe that U.S. Treasury yields, so the 2 to the 10-year, are actually higher today than 1 month ago. They are flat now, uninverted we saw, but now they're higher than actually in July. So despite Jackson Hole's speech, when Powell said that inflation is receding and then we will see some, monetary loosening policy coming, you can also see benign inflation prints. Benign means better. And also there's a fears of slowing economy. We will think the rates and the market will show lower rates, but actually August rates were higher than July. So that is a little concerning because the market seems that we need to high rates for longer. So I don't know. Now, the election. Trump wants lower rates and tariffs. You can have both. if you lower your rates, your US dollar goes down, and then the cost of your imports go up. If you then increase tariffs, the cost of your import goods will just skyrocket. You can have that. And then Kamala Harris also wants a weaker USD and more regulation. So the Fed Reserve has done, they say, a good job, but I don't think the job has been good for this cycle. The wrong aspect is having rates from 2009 to 2016 completely flat, and then during an inflation period, the amount of quantity easing and the amount of money in the market is just unbelievable. The amount of debt that this country is going through, and the monumental capital misallocation in AI, artificial intelligence, where we see NVIDIA having extremely valuations of $3 trillion company just based on future revenue. And there's also a dysfunctional government spending in every segment. And we see higher rates and also see gold just going up and up. There's definitely an issue in the economy that goes beyond inflation. It's in the debt, in the structure, and it's in the misallocation of capital. And this is what we're talking about. Look at this. The July rates are lower than August yield curve. For example, the 2-year 388, now it's 391. The 10-year it was 380, now it's 391. That's 11 basis points. Same with the 30-year and 20-year. So basically everything since the 6 month, it is higher now. So shows, yeah, there might be a rate cut pretty much guaranteed in September, but the market is not very confident on that being the best move. And why? Because the dollar index currently, this is the year-to-date graph, it's currently at 101, give or take, based on when you're seeing the graph. We saw it on September 2nd. So the 200 moving day average is 103. So there is a clear path down. And you can see here in the middle, when the index was really high, that's April and May, which is where our rates were higher. So if you go to basic 101 economy, currencies are usually priced based on the interest rates differential. So you have a currency like the USD, which is backed by the US government, which has pretty decent rating, and rates are higher, then all the capital will come into that instead of going into a lower currency. Although the rates will be higher, but maybe the risk premium, the interest rate premium might not be the best, so you just flow into the US dollar. But however, we still have high rates, and then the dollar index is going down, there's something going on. If you drop rates, you're going to see even a weaker US dollar, and this is what concerns us. But in the end, the Fed can cut more than 25 bips because it weakens the dollar even further. And inflation is not defeated yet. The economy is still strong and unemployment is still under control. So there is no reason to cut higher than 25. In mere finance, we think the Fed shouldn't even cut rate, but it seems like the market participants and the Fed and everyone is expecting at least a 25 cut. And why is the US dollar so important for the election cycle? So both Harris and Trump want a weaker USD. Why? Because that will strengthen, according to them, the economy, which they don't know is actually they will increase the costs of import goods. And they want to decrease the USD so they can provide more social services and they can expand the government. Because Trump is not really that conservative that we saw in the 80s or in the 70s where we're actually fiscal conservative. Under Trump, national deficit and debt just skyrocket. So he's no conservative in terms of policy. Now, however, Harris has something that can affect the economy more than Trump is the punishment of capital. Because Harris doesn't really care about punishing capital if she's able to pass regulation and tax reform that can contribute to a bigger government so she can provide more social services. Trump, on the other side, is more into lower regulation and protectionism. So in the long run, I think GDP will grow higher under Trump. Debt ratio debt over GDP in Harris will be higher than debt on the GDP with Trump. However, under both of them, we'll see 25% at least more debt in the next 40 years for the US. And basically, the US is just going to become a nation that has higher levels of debt. And eventually, it will start to collapse because you cannot sustain so much debt without the same production. So both of them, I think, want to politicize Fed Reserve so they can have lower rates, because Trump needs lower rates. So assets increase, and then people are like happy with their 401ks and their assets completely inflated, and Harris needs a lower USD, lower rates, so she can promote more spending and provide more social services. So not a really good picture between both of these candidates, but they are also dependent on USD. So hopefully the Fed stays away from it, becomes centralized in the dual mandate instead of what politicians want. So let us know what you think, and we're excited for Friday's job report to see how the economy is doing.